Every major purchase that we make gets financed. It's typically one of four ways. Most people know about two of them. Some people know about three. Nobody talks about the fourth, which happens to be the only way where finance cost stays in your pocket instead of someone else's. Today we're walking through all four. We're looking at real numbers, and by the end of this video, you're going to see any future financing or future purchases completely different. I'm Jared with Green Dot Wealth, where we help families build generational wealth by changing the way they think about money and how it moves through your lives. This video is about one of the most practical concepts in personal finance and one of the least taught. It doesn't require any prior knowledge of infinite banking concepts or whole life insurance. It just requires a willingness to look at the math honestly. Option 1, you borrow from a bank or a lender. A car loan, a home equity line, a personal loan. You go to the financing institution, they extend you the credit, and you pay it back over time with interest. Simple enough. But let's look at what it actually costs. Let's say you're financing a $35,000 vehicle over the course of 60 months at 7% interest. Your monthly payment is $693. Over the life of that loan, you'll pay roughly $6,600 in interest. Money that leaves your life permanently and goes directly to the lender's bottom line. You get the car. They got $6,600 of your future earnings. That's the deal. Option 2, use a credit card. Same purchase, different mechanism, but the interest rates are a lot higher, and so this compounds over time. A $35,000 purchase, paid back at $693 a month, costs you nearly $14,000 in interest when it's all done. Both of these options have the same fundamental structure. You need capital, you go get it from an outside lending institution, and you pay a premium for that privilege. The financing cost leaves your world entirely. It's gone. Now, here's where it gets interesting, because option 3 is the one most people think is the smart move. Option 3, you pay cash. You've saved up, you pull $35,000 from your savings account, and you buy the car outright. No loan, no interest, no bank involved. On the surface, that looks responsible, like the disciplined choice. And in a lot of ways it is. But there's a cost hiding in that process that almost nobody talks about. When you pull the $35,000 out of your savings and pay cash, the money is gone from your financial system. It can't grow anymore. It can't compound. It can't be deployed elsewhere in the case of an emergency. What could that money have earned had it stayed working in your system? Instead, it disappears the moment you spend it. Let's say that $35,000 was earning a modest 4% annually. Over 5 years, the opportunity cost of removing it from your system is roughly $7,600. Not in interest paid to the bank, but growth you never received. So paying cash isn't free. It feels free because there's no monthly payment, no statement along with it, nothing reminding you, but the cost is real, it's just invisible. And here's the part that really matters once the money is spent. It's gone from your world permanently. You can't get it back. You've paid for the car. Yes, you have the car, but you've permanently reduced the pool of capital available to you for the next opportunity, the next emergency, or the next thing that comes along. Paying cash is better than paying high interest to a credit card company, but it's not the optimal solution. Because there's no version of paying cash where your capital stays intact and keeps working for you. This leads us to option 4, the one hardly anybody talks about. Option 4, you finance the purchase through your own properly structured, dividend-paying, whole life insurance contract. Here's how this works in practice. You've been building a pool of capital inside a whole life contract, cash value that's been growing, guaranteed, uninterrupted. And when you need that $35,000 for the car, you take a policy loan from the insurance company, using your cash value as collateral. A few things happen here worth understanding. First, the insurance company lends you their money, not yours. Your cash value stays fully intact, fully inside of this contract, that continues to grow as if the loan never happened. You haven't removed your capital from your system. The full $35,000 in cash value is still compounding. Second, you repay the loan on your own terms. There's no rigid repayment schedule set by a bank, no penalty of paying ahead or behind. You set the terms, and when you repay, ideally on the same schedule that you would have paid a conventional lender or better, that money flows back into your system, back into your bank. Third, the financing cost stays inside your own ecosystem. Instead of spending $6,600 to go to the bank's bottom line, that money will be paid in the form of a loan, but it will be paid to a system that you're a part owner of. Now let's be precise about what this is and what it isn't. The interest on the policy does go to the insurance company. This is not zero cost financing. But when you combine the loan interest with the uninterrupted growth of your cash value and the dividends that are still going to be expected to be credited to your contract, the net cost is significantly lower. So let's be precise about what this is and what this isn't. The interest on the policy loan does go to the insurance company. This is not zero cost financing. But when you combine the loan interest with the uninterrupted growth of your cash value and the dividends that are not guaranteed but expected to show up as they have for the last 120 years, the net cost is often significantly lower than a conventional loan. And unlike a conventional loan, your capital base remains intact. You got the car, your capital kept working, and the financing costs largely stayed within your system. And as you repay, you rebuild the pool of which you're able to borrow from again, without interrupting compound growth. That's option 4. So let's put all 4 side by side. Option 1, bank loan. You get the capital, you pay $6,600 in interest. That leaves your life permanently. Your capital base stays intact, but you're obligated to the lender. Option 2, with the credit card, you get the capital, but you pay over double in the interest cost. Money that leaves your system permanently, and you're at the mercy of the rate that can change. Option 3, you pay cash. You avoid interest, but $35,000 leaves your financial system permanently. The opportunity cost is real and invisible, and your capital pool shrinks. Option 4, you own the system. You get the capital, your cash value keeps growing, your financing costs are largely reduced and it recirculates, and the capital base remains intact. Here's what's worth noting. In options 1, 2, and 3, the financing cost, whether it's interest paid or opportunity cost lost, it leaves your financial world forever. In option 4, it doesn't. That's the difference. Not the rate of return comparison, not a yield argument. It's about whether or not the financing cost for every purchase in your life leaves your financial system or stays inside of it and keeps working. You're going to finance everything you buy. That's not a choice. It's an economic reality. The only choice is which of these 4 options you choose. And only one of them keeps your capital intact while keeping the financing costs inside your own system. The question worth asking about every major purchase from here forward is which option are you using and what it's really costing you. This type of understanding is what was so attractive to me personally and why I chose to work with infinite banking concepts. Even though I considered myself to be pretty financially savvy throughout most of my life, I never truly understood this concept. When this sunk in, I needed to learn more. I needed to know what that looked like. The idea of financing through your own system rather than someone else's bank, that was important to me. The best place to start is with this book, Becoming Your Own Banker by R. Nelson Nash. It's the foundational text of everything that we've talked about today. It's short but dense, and it's worth every minute. I'll put a link in the description. And after you've read it, and you're ready to talk about building your own system and what that might look like to exercise option 4 in your own household, come find me at greendotwealth.com and book a free 30-minute call where we'll talk about what your current system is and how you can set this up for you and your family. No pressure, no pitch, just an honest look at what the math looks like. You can also find a weekly updated blog on my website called the Green Dot Intelligence Report that will analyze a variety of financial situations and scenarios and how infinite banking applies. I'm Jared with Green Dot Wealth. I'll see you next week.